the average directional index, ADX, minus directional indicator, minus DI, and plus directional indicator, plus DI, represent a group of directional movement indicators that form a trading system developed by Welles Wilder. Although Wilder designed his directional movement system with commodities and daily prices in mind, these indicators can also be applied to stocks. Positive and negative directional movement form the backbone of the directional movement system. Wilder determined directional movement by comparing the difference between two consecutive lows with the difference between their respective highs. The plus directional indicator, plus DI, and minus directional indicator, minus DI, are derived from smoothed averages of these differences and measure trend direction over time. These two indicators are often collectively referred to as the directional movement indicator, DMI. The average directional index, ADX, is in turn derived from the smoothed averages of the difference between plus DI and minus DI. It measures the strength of the trend, regardless of direction, over time. Using these three indicators together, chartists can determine both the direction and strength of the trend. Wilder features the directional movement indicators in his 1978 book, New Concepts in Technical Trading Systems. This book also includes details on average true range, ATR, the parabolic SAR system and RSI. Despite being developed before the computer age, Wilder's indicators are incredibly detailed in their calculation and have stood the test of time. Directional movement is calculated by comparing the difference between two consecutive lows with the difference between their respective highs. Directional movement is positive, plus, when the current high minus the prior high is greater than the prior low minus the current low. This plus directional movement, plus DM, then equals the current high minus the prior high, provided it is positive. A negative value would simply be entered as 0. Directional movement is negative, minus, when the prior low minus the current low is greater than the current high minus the prior high. This minus directional movement, minus DM, equals the prior low minus the current low, provided it is positive. A negative value would simply be entered as 0. The chart on the screen shows 4 calculation examples for directional movement. The first pairing shows a big positive difference between the highs for a strong plus directional movement, plus DM. The second pairing shows an outside day with minus directional movement, minus DM, getting the edge. The third pairing shows a big difference between the lows for a strong minus directional movement, minus DM. The final pairing shows an inside day, which amounts to no directional movement, 0. Both plus directional movement, plus DM, and minus directional movement, minus DM, are negative and revert to 0, so they cancel each other out. All inside days will have 0 directional movement. The average directional index, ADX, is used to measure the strength or weakness of a trend, not the actual direction. Directional movement is defined by plus DI and minus DI. In general, the bulls have the edge when plus DI is greater than minus DI, while the bears have the edge when minus DI is greater. Crosses of these directional indicators can be combined with ADX for a complete trading system. Before looking at some signals with examples, keep in mind that Wilder was a commodity and currency trader. The examples in his books are based on these instruments, not stocks. This does not mean his indicators cannot be used with stocks. However, some stocks have price characteristics similar to commodities, which tend to be more volatile with short and strong trends. Stocks with low volatility may not generate signals based on Wilder's parameters. Chartists will likely need to adjust the indicator settings or the signal parameters according to the characteristics of the security. At its most basic, the average directional index, ADX, can be used to determine if a security is trending or not. This determination helps traders choose between a trend-following system or a non-trend following system. Wilder suggests that a strong trend is present when ADX is above 25 and no trend is present when ADX is below 20. There appears to be a gray zone between 20 and 25. As noted above, chartists may need to adjust the settings to increase sensitivity and signals. ADX also has a fair amount of lag because of all the smoothing techniques. Many technical analysts use 20 as the key level for ADX. The chart on the screen shows Nordstrom, JWN, with the 50-day SMA and 14-day average directional index, ADX. The stock moved from a strong uptrend to a strong downtrend in April to May, but ADX remained above 20 because the strong uptrend quickly changed into a strong downtrend. There were two non-trending periods as the stock formed a bottom in February and August. A strong trend emerged after the August bottom as ADX moved above 20 and remained above 20. Wilder put forth a simple system for trading with these directional movement indicators. The first requirement is for ADX to be trading above 25. This ensures that prices are trending. Many traders, however, use 20 as the key level. A buy signal occurs when plus DI crosses above minus DI. Wilder based the initial stop on the low of the signal day. The signal remains in force as long as this low holds, even if plus DI crosses back below minus DI. Wait for this low to be penetrated before abandoning the signal. This bullish signal is reinforced if, when ADX turns up and the trend strengthens. Once the trend develops and becomes profitable, traders will have to incorporate a stop loss and trailing stop should the trend continue. A sell signal triggers when minus DI crosses above plus DI. The high on the day of the sell signal becomes the initial stop loss. The chart on the screen shows Medco Health Solutions with the three directional movement indicators. Note that 20 is used instead of 25 to qualify ADX signals. A lower setting means more possible signals. The green dotted lines show the buy signals and the red dotted lines show the sell signals. Wilder's initial stops were not incorporated in order to focus on the indicator signals. As the chart clearly shows, there are plenty of plus DI and minus DI crosses. Some occur with ADX above 20 to validate signals. Others occur to invalidate signals. As with most such systems, there will be whipsaws, great signals, and bad signals. The key, as always, is to incorporate other aspects of technical analysis. For example, the first group of whipsaws in September 2009 occurred during a consolidation. Moreover, this consolidation looked like a flag, which is a bullish consolidation that forms after an advance. It would have been prudent to ignore bearish signals with a bullish continuation pattern taking shape. By contrast, the June 2010 buy signal occurred near a resistance zone marked by broken support and the 50 to 62% retracement zone. In this instance, it would have been prudent to ignore a buy signal so close to this resistance zone. The chart on the screen shows AT&T with 3 signals over a 12-month period. These 3 signals were pretty good, provided profits were taken and trailing stops were used. Wilder's parabolic SAR could have been used to set a trailing stop loss. Notice that there was no sell signal between the March and July buy signals. This is because ADX was not above 20 when minus DI crossed above plus DI in late April. The directional movement system indicator calculations are complex, interpretation is straightforward, and successful implementation takes practice. Plus DI and minus DI crossovers are quite frequent and chartists need to filter these signals with complementary analysis. Setting an ADX requirement will reduce signals, but this uber-smooth indicator tends to filter as many good signals as bad. In other words, chartists might consider moving ADX to the back burner and focusing on the directional movement indicators, plus DI and minus DI, to generate signals. These crossover signals will be similar to those generated using momentum oscillators. Therefore, chartists need to look elsewhere for confirmation help. Volume-based indicators, basic trend analysis and chart patterns can help distinguish strong crossover signals from weak crossover signals. For example, chartists can focus on plus DI buy signals when the bigger trend is up and minus DI sell signals when the bigger trend is down.